So this time, we will try problem 1612, that Foxborough one, okay? So anyway, if I was going to start a cash flow, oh, by the way, the problems I'm going to give you are the indirect method, right? Direct method you'll learn how to do in Accounting 313 if you're accounting or finance both, major, right? Yeah, but the indirect method is relatively straightforward, pretty simple, especially current assets. That's the big difference, right? On the current assets and current liabilities, you just put down the change in them. But anyway, how would you start this statement? Let's just go ahead and do it, okay?
Well, you have to write down the title.
Yeah, let's write down the company's name first. Huh? Be sure and do that. I'm going to probably give you a point for doing this kind of stuff. Maybe a point for the whole heading or something, you know, that kind of thing. So be sure to get the point. So it's Foxborough Company, is it? Mm-hmm. So write it down, and then you can abbreviate for me. It's fine. When you're in Alan Deck's classes in the future, ask him. Sometimes he wants everything written out, sometimes not. But anyway, Richard Schrader, I don't know. A little both, probably, too. If somebody says in good form, they mean everything perfect. Right? Otherwise, you can abbreviate. Oh, when you do abbreviate, don't use INV for investment inventory both. Right? I can't tell them apart. So make sure your abbreviations are complete enough. So anyway, you can put INT for inventory, right? INVEST for investment. I can handle that much. Funny. Anyway, but yeah, you do that. Okay, then what do you do?
Operations.
Statement of cash flows.
Statement of cash flows.
Statement of cash flows, yeah. That took too long. So we got statement of cash flows or cash flow statement. Then what?
The ending.
For the year ended. And of course, in real life, we write it out. Okay, for the year ended. And what's the year end on this one? Year one and year two. Whatever. Okay, year two. Okay, got it? So you put the date, of course, in real life. Okay, and then would you say the section where are they going?
Operations.
Operations or operating.
Investing.
Okay, and then go down about half the page. Okay, so put that at the top of the page, you know, towards the top. And then go down about half the page, because that's going to be about half of the statement. That's why I say that. Then you can write it wherever you want it to go, huh? Get in the right section. So pretend I'm just down half a page. This sheet is not the right shape for me, but anyway. Yeah, so then what's the next section? Investing. So I'm down half the way. Everybody got the idea? I don't know why I use small case caps. I don't know. All right, investing. And then what? Financing. It can all be normal case, right? Small case. All right, good. And then, what are you going to put under operations? Operating activity. Net income or net loss. And change in current assets, current liabilities. And non-cash items that are income statement, like adding back depreciation.
See non-cash items?
Yeah, and non-operating stuff that's also in there, like gains and losses on equipment, sales of equipment, or investment or any non-current asset.
Why would you put non-operations in operations?
Because they took it out of the income statement, so I'll add it back. Because I just want operating stuff under operations. I don't want the non-operating stuff. I want that over in investing and finance.
So the non-operating you add back?
Yeah.
Okay.
That's it.
Always add back, or can it be?
Well, no, sometimes you deduct it.
Okay.
If it's a loss, you add it back. If it's a gain, you take it out.
Okay.
Okay, so we'll look at that, okay? When we run through here, we'll talk about that. Okay? What do you do under investing? What are you investing?
Non-current assets.
Non-current assets. It's buying and selling non-current assets, okay? What goes under financing? Where's your financing come?
Non-current liabilities.
Non-current liabilities, so issuing debt and paying it off, right? We both go in there. And then what else?
Equity.
Equity. So issuing stock, paying dividends, buying back stock, right guys? That's what's going to go in there. Okay, and then the total of these three sections is going to be what? It's going to be the change in cash. It'll be either an increase or decrease in cash. What happened to cash? Oh, by the way, be careful. Sometimes these problems will have the first year in the first column and the second year in the second column. And sometimes it'll be like this, year two in the first column and year one in the second column. Read carefully. It's all you can do. Okay, and they even do that in the CPA exam, and I don't know why. But in real life, of course, if you're doing a real financial statement, this isn't a financial statement, this is a trial balance. But if I was doing a real balance sheet, of course, I'd put the most recent year first and the oldest year after that, right? And most recent is probably more important to people. Anyway, so this is going to be the change in cash. Did cash go up or down? Went down by 8. So I'd say decrease in cash. Sound good? How much did it go down by?
8,000.
Put brackets around it because I have less cash, right? Brackets indicate less. No bracket indicates more. So don't put plus and minus, okay? Nobody does that. Right? I need to bother. So yeah, we're going to put brackets around it. Okay, and then let's add it to the beginning cash. No kidding. What's the beginning cash?
19,000.
90? A lot of cash, okay, for this size company. And then what's the ending cash?
19,000.
Oh, then it wasn't a lot of cash. It was 19. Oh! That's what I get for starting over. Okay, what was the change again? Decrease of
8,000.
8. Beginning cash was 19. Ending cash? Looks like it's 11. Does that sound good?
Yeah.
And then, of course, you double underline into that, okay? Sound good? And you have now got the answer. The answer is -8. Isn't that cool? If you're doing a problem, we already know the answer. And by the way, at this point, I would probably give you 4 points out of 30. Really? For doing that? Really? If you know what the statement looks like, you got 4 points, maybe 5. Okay, all right? So make sure you lay it out right. Okay, and now it's really easy. You just plug it in again. All right, so where do you want to start? Which account would you like to start with? It really doesn't make any difference. What do, though? You make sure you write down the change in every balance sheet account once and only once. Have I written down any of the changes in any of the balance sheet accounts yet? Yes. Which one? Cash. Please put a check mark next to cash and don't write it down again. I actually have people do that. Under the current assets, they'll write down cash, and at the bottom, they'll write down cash again. Like, what? Don't do that, right? Of course, it won't total with the change in cash. You write down the change in cash, right, and then add it in with them. Okay, got it? Everybody good? This is easy, isn't it? You want to start with net income? I don't care. That's fine. What account? Because he remembers that net income is the first thing under operations. Fine. If you remember that, great. If you don't, will you remember later? Of course, because which account in the balance sheet has net income in it? In the balance sheet, which account has net income in it? Retained earnings. Of course, so when you analyze retained earnings, you'll find net income, and you'll, oh, right, that goes under operations. So you don't have to remember anything, right? You just figure it out. So if he wants to start with net income first, by the way, what if it was a net loss? I'd put brackets around it. If it's net income, I'd make it a positive number. What was net income?
63,000.
63. Okay, now what account am I doing? Are all these even thousands? Yeah, let's leave the thousands off. It's in thousands. And what you can do is you go like this. In thousands. You like that? Ah. Okay, so now I can just write 63. Okay, it makes the statement less cluttered. We'll leave here while we're writing it all. So I got 63 there. What account did I just start analyzing, you guys? I don't want to write anything down here unless I'm analyzing an account, right? Changing the account on the balance sheet. I wrote down that 63. I'm analyzing some account. What did we say it was?
Retained earnings?
Yeah, I mean retained earnings. What happened to retained earnings because we had net income of 63? It went up, right? Everybody knows that's a credit to retained earnings of 63. What did we start with in retained earnings? I didn't even see that there. So. Yeah, but it seemed I called you, I guess, or tried to. Yeah. Okay. So anyway, what do we got? What do we have at the beginning in retained earnings? 90. What do we have at the end?
20.
How much do we really want to explain on a cash flow statement? To change it how much? 30, of course, right? But we've already put in 63, so what else must there be?
Dividends.
It's got to be dividends. And I think they told you the dividends, but they didn't need to. Did you figure out what the dividends have to be? Sure. Retained earnings only went up by 30, and there's net income of 63. How much do they pay out? 33, of course, so the dividend's 33. So we already put on our cash flow statement the 63. What else do we better do now? Write down 33, of course, right? Let's do it. Where does it go?
Financing.
Under financing, because it's a transaction with the owners, right? returning some of the equity to the owners. Let's just call it dividends paid. And if they weren't paid, it could be dividends declared. That'd be fine. I know that they were paid because there's no dividends payable. Right? So it was dividends paid. It was actually paid, plus they told you they paid them. So 33,000, do we have more or less cash?
It was paid because what?
Because there's no dividends payable, it had to have been paid, right? Otherwise, you'd have 33,000 in dividends payable, wouldn't you?
Yeah.
They hadn't paid them. They must have paid them, but they told you that too. So they didn't have to tell you anything about the dividends, but they did. It's okay. So is that more or less cash? Yeah, it's debit, retained earnings, credit, cash. Absolutely, you got it. Less. And by the way, net income. Oh shoot, I put zeros on all those that didn't here. I'm going to make them all zeros. Sorry, because I started it. Okay, but anyway, what does net income do? The 63,000 net income. Assuming all your revenues are cash and all your expenses are cash, but they're not, but if you made that assumption, what would be the change in cash that you'd have? Oh, 63,000 more if you have 63,000 net income, right? Okay, so it's kind of how you think about it. And then we're going to adjust that 62,000 to get to cash basis. So anybody want to do another account? Pick one. I don't care.
Accrued liabilities.
You want to do current liabilities?
Accrued
How about if we did all the current assets and current liabilities at once so we can accumulate a whole bunch of points? Because he's going to give you 1 point for each one. And they're really fast showing the change. Where do they go?
operating activities.
Under operating activities. Why? The reason I have inventory is so I can get sales. The reason I have accounts receivable is so I can get sales. The reason I have prepaids is because I have to run my business. The reason I have accounts payable is that I get to. That's how I borrow the money to finance my inventory account. Right, you got it? Why do I have accrued liabilities? Because I get to. It's interest-free borrowing. Why not? I'm going to pay my employees later, right? Pay my rent later, whatever it is, right? That's why we have those things. It's all for operations. So let's leave some room because we're going to put some other stuff in there. There's going to be depreciation, amortization, maybe. There's going to be maybe some gains and losses, that kind of thing. So let's go down a ways and let's put changes in current assets. And while we're at it, why not do changes in current liabilities? Be good. Okay, what are the current assets? So we can start checking things off. We got retained earnings and cash so far, so what's the first one we're going to do for current assets? How about accounts receivable? You guys like that? What happened to accounts receivable?
It went up.
So it's an increase in accounts receivable. If I have more accounts receivable, how many more is it? 7?
7.
If I have 70,000 more accounts receivable, what happened to my cash? Included in your sales is 70,000 you did not collect. So compared to your net income, how much cash do I have? More or less? Less? Got it. You can just pretend you bought the current asset with cash if you want, right? That works fine. Okay? I'm done with the accounts receivable. Check it out. Inventory, what happened?
It went up 48,000.
It went up 48. What must you have bought it with? Assuming all other things stay the same, we'll do accounts payable separately. That must be less cash too, huh? Increase in inventory. What if it went down? What if either one of those went down? I'd have more cash, right? Yeah, on the inventory, I would have sold it and I'd have cost of goods sold to use more cash, right? What do you think about it? The receivables are actually collecting the cash, right? Okay, if they go down. Well, we got prepaids left. Which direction that go?
Down.
Okay,
So you have
so decrease in prepaids. So it went down. So I have 9,000 decrease in prepaids. What does that mean? I debit expense and credit prepaids. That expense used no cash, right? So I have more cash because I didn't replace the prepaid. Everybody agree? That's it. Compared to what my net income shows. I'm just adjusting the net income to cash basis. Now I can check off that account. And we're flying, aren't we? Loan to Harker is probably non-current. I think that's the assumption I would make. Okay? It didn't say, and it really shouldn't. The problem would be better if it did. Let's assume it's non-current. Okay? All right. Well, let's skip that for a minute then, and let's do the current liabilities. Why not? Oh, by the way, they put accumulated depreciation down under credit balance accounts, but that's not liability just because it's a credit. What is it?
Contra asset.
Contra asset. So that's going to have to go with plant and equipment, isn't it, up there? Right, guys? Okay, anyway, so which is the first current liability?
Accounts payable.
So you're in big trouble if you don't know a current liability from a non-current liability and a current asset from a non-current asset, huh? But you all do, don't you? Those folks who didn't left. They're coming back next semester to do a really great job. Well, some of them are. Okay. Anyway, some are not. Anyway, Accounts payable, what happened? Increase or decrease?
Increase
How much?
50.
So what does that mean? You didn't pay 50,000 of your bills, so you have expenses of 50,000 you did not pay for. Do you have more or less cash if you don't pay your bills?
More.
More, yeah, that's fine. I don't mean you're behind on paying them, it just increased. Okay, so it's interest-free borrowing, that's nice. You got 50 more cash. What happened to accrued liabilities?
They went.
They went down. So when you decrease a liability, what happens?
You lost. What you
Well, you paid off some of it. What'd you pay it with?
lost.
Cash. So in the account payable, they borrowed money, right? In the accrued liability, they paid it off. So they paid with cash, of course. And you can just think about it was 8,000, wasn't it? I'd have less cash. Think about what the journal entry is. On accounts payable, what was it? Debit expense or debit inventory maybe, and credit accounts payable, right? I have more cash than I paid it off, right? And if I paid it off. How about on the accrued liability? It's actually debit, the accrued liability and credit cash. Salaries payable, rent payable, whatever it is, interest payable. Got it? Utilities payable. Excuse me. Okay, the cold's finally breaking a little bit. You know, a few days in Florida would be good for me. You miss me long gone? All right.
What's gonna be like down there?
You're going to be watching me on videos. Well, you'll be seeing me, but you'll be listening to me, won't you? If you have any sense, you will. You're getting ready for your test. I would if I were you. Okay, so, and it's terrible. I'm actually canceling 2 of your classes, taking time away from you guys. Oh, we have 30 hours of review sessions. I guess it's okay. You're probably okay. Use those. And if you weren't at them, use them anyway. It pays off. Okay, anyway, well, we can check that one off. Now what do you want to do? Want to do bonds payable? Keep going with that? I don't care. We haven't done loan to Hartford plant
I thought
equipment.
bonds payable was a non-current liability.
It is, I know, but we're done with the current one, so we have to stop on those. That's the last current one. Okay, if there were more current ones, we'd keep going, right? Okay, but he wants to do bonds payable next, I don't care. So we don't have that checked off yet, right? And we still don't have loan to Hartford checked off or plant equipment checked off for accumulated depreciation. But we can do bonds payable next, I don't care. My point is, it doesn't make any difference what order you do these in, right? Whatever occurs, you get it down. But when you do the account, do the whole account, okay? Don't do part of it. Like we did on retained earnings, right guys? We did both sides of retained earnings. We didn't just do one side, right? And then come back later and either not do it, or I'll have people they'll put down the 63 net income and then they'll put down the 30 change in retained earnings. Those two things. Is that gonna work? Well, no, you're explaining a 30 change. You put down the 63, you better have the other direction, the 33, right? The dividend. Okay, so
So all these current liabilities and assets, just like, you just subtract the two and just whichever's
it's a
negative?
change.
Okay.
That's because there's lots and lots of transactions that are real small. So it's kind of meaningless to write down what the
Yeah.
what the debit was and what the credit was, basically. Yeah, just to the net, the two, right? That's it.
Okay.
That's what the indirect method does. So it's real easy, isn't it? Okay, so now let's try bonds payable. You must do bonds payable next. I don't care what we do next. What happened to bonds payable? What did it start out at? 100, was it? What did it end up at? 90. 190. Okay, so what happened? We issued at least how much? 100. Now, could we have issued more? Yeah, and when you read down below, they don't say anything about bonds payable, so apparently they didn't. But could they have paid off the whole 100 here and then issued 190? The answer is, of course, that could have happened, right? And if they did, what would you do? I would show cash coming in from issuing bonds payable, and I'd cash going out from paying off the bonds payable, because those are real material numbers. They're big, right? And so if they're in the investing or financing section, you always show both the increases and decreases. It's only the current assets and current liabilities over in operations where you just show the change. Got it? I'm gonna follow on to his question. But in this problem, what do we have, you guys? It doesn't say anything about it retiring any, so what must have happened? What would be your assumption? They issued 90, big deal. It'd be credit bonds payable and debit what, everybody? You guys know how to issue bonds payable. What do you debit? Cash. And of course, there'd be a premium or a discount in real life. You'd have to look what net cash was. It's a little more complicated. What do you want to do with that cash? Where do you put it? I borrowed long-term debt. Where does it go? Financing, that's the trick. If you know that, you got it made, don't you? It's financing, because it's long term. So under financing, I'm gonna write down issue, bonds payable. It's not magic, is it? This is stuff you already know. It's just letting yourself use it. How much was it, 90? Good. Everybody got it? I have more cash because I issued the bonds. So now you can check off bonds payable. You want to do deferred income tax next, seeing as we're going down that line? I don't care. What is the deal with deferred income tax? Now this is a little different. We did this really just a tiny bit in the accounts payable chapter, but I was mostly doing present value in there, the current liability chapter. I mostly did present values and future values, remember, since you go on that. So here's a little bit that maybe we didn't get real clear there. We've got this account called deferred income tax payable. What is that? Deferred income tax payable. I am going to be able to put off paying my taxes to the federal government, to the IRS, right? For an indefinite period of time. What happens is I compute how much tax expense I should have, that I have, based on my income. Well, where would I find that? It's tax expense in the general ledger, right? But we don't have the revenues and expenses. Instead, they gave us an income statement, so let's just look at the income statement. Do you see tax expense in the income statement? Yeah, less income taxes is $27,000. That's tax expense, isn't it? So do you debit or credit to increase expenses? Debit. It's a debit to income tax expense. That's what they did for $27,000. Now here's the deal. That's based on their income, right? On their financial statements. But they get to pay less. How does this work? UPS buys brand new airplanes, brand new trucks. And what do? They depreciate it really fast at the beginning. Under what? First 3 years. Modified accelerated cost recovery system, you read about, right? Very rapid depreciation, unrealistically low lives. Far less time that they can actually use the asset, right? That it's going to actually last. Okay? And usually double declining balance, right? Accelerated methods of depreciation. So they have huge depreciation amounts on their tax return. What do they put on their financial statements? A straight line, normal life, right? So there's a lot less depreciation expense. This is just one example, right? They have a lot less depreciation expense on their tax return than they do on their financial statements. They have a lot more on their tax return than they do on their financial statements, which does what? I have less taxable income than I have income on my income statement. Got the idea? But what would happen in the later years if they keep these assets? In the later years, if they keep them, what happens? They already depreciate them. There's nothing left to depreciate, right? For tax purposes. So now all of a sudden you have to start paying those taxes. You'll have less tax expense in your financial statements than you do in your tax return. And the deferral would reverse. What they do instead, of course, is, the idea of the law, is they'll sell those assets so they can keep having more deferred income tax. So what happens is big, powerful companies, rich companies, buy brand new assets like UPS, They buy new assets, right? Use them for a short period of time, which is nice. They always have new trucks, right? And then it helps their business. And then they are encouraged to sell it by the tax law. And then when they sell it, they're still in really good shape, and who gets it? A smaller company that probably couldn't afford brand new ones. And it's good for the economy. And also it generates jobs, of course, manufacturing equipment, and selling equipment, and all that, right? So the economic activity. Does it cause big companies, any company really, that has equipment, new equipment, does it have them pay less taxes? Yes. By the way, would you rather pay taxes now or 10 years from now?
10 years from now.
Yeah, 10, time value of money. How about even 1 year from now? Yeah. What if it's $10 million and I get to wait 1 year? I'll take that, wouldn't you? Right? Interest-free borrowing from the federal government is what it is. Everybody says this is tax loopholes. It is not. It was intentional. Congress wrote it intentionally. It was to generate jobs and to generate economic activity to generate jobs. Right? Does it help the economy? Yes. Is it bad for the environment? Well, maybe. Because we're manufacturing a lot of stuff. And we are, churning, right? Throwing things away, maybe, before we really should. Did you guys see the horrible thing that happened in Egypt with the Russian plane going down? Somebody in the last class said that the most recent thing she heard was that it probably was mechanical failure. Everybody in the plane died, and they thought that ISIS shot it down. Well, they couldn't shoot it down. They don't have the ability yet, apparently, in Egypt, or they don't have it. Thank goodness. Maybe, hopefully, now. Okay, so they couldn't do it. And then they thought maybe a bomb. And she said what they did was they repaired the tail section a few years ago, was damaged, and they didn't do it right, they think. And so it was inadequate repairs. It's an 18-year-old plane. Where do you suppose the plane probably started? Either the US or Europe. And then we got rid of it because we like to have new planes that are safer. And our airline companies can afford it. And they sold it probably to this Russian airline. You know, it's a charter airline, right? And vacationers, right? Cheap fares. Awful, huh? And they didn't maintain it. Well, how long will a jet aircraft last? 18 years is not the life of these things, right? They last easily 30, 40 years. If you do what? Maintain them properly. They didn't. And maybe that's what it was. Or maybe it's lost. Okay? But in any event, so there are side things to this too, huh? Right?
I can afford to take care of
Why are our bridges falling down, you guys? Because they're too old? No, because we didn't take care of them. We didn't maintain them because we didn't want to pay any taxes, so we didn't maintain them properly. And now we can't fix them. So guess what? Your generation gets to replace them all. You're welcome. Our freeway system is a mess because we didn't take care of all the overpasses. You know, when you drive on the freeway, you see how many bridges are being replaced? It's because we didn't properly maintain them, for the most part. It's crazy. It's crazy. What happens if you build a house and you never put a roof on it? How many years does it last? A house will last almost forever if you take care of it. Of course, you keep replacing it. That's what my dad always says to build it, right? He says the neat thing about the building industry is you build something and it immediately starts to fall down unless you keep repairing everything, replacing it. What happens if your roof leaks and you don't fix it? The house rots out from under it and it falls down. You tear it down. What happens if you don't fix it? By the way, when you buy a house, what happens if you have a leak in your bathroom and there's water flowing on the floor? The wood floor rots underneath it, and you have to take your bathroom out and replace the floor and put in a new bathroom. So which is cheaper, fixing the leak or replacing the floor? Wow. Yeah, wow. So, you know, you think about this stuff, right? Anyway, why does that do with this? I don't know. Okay, the debit income tax expense, right? What would be the tax payable here? Well, let's see. Cash is the amount they must have paid because there's no income tax payable. And then deferred income tax payable, what happened at the beginning? What was deferred income tax payable at the beginning?
80,000,
What is it at the end?
84.
What happened? They borrowed 4 more. Who'd they borrow it from? Federal government. Ah! So how much cash does they pay out? Only 23,000. How much tax expense is there on the income statement? 27. But only 23 got paid out. So what do we do with this increase in deferred income tax? We add it back to net income. Add the increase in deferred income tax. If it goes down, it'd go the other way, right? Because I must have paid it off. If it goes down with cash, if it goes up, my tax expense on my income statement, which reduced my net income, right? Everybody agree that 27 came out of net income, right? 90 less 27 was 63. So 27 came out of net income, but only 23 got paid. That's a tough one, isn't it? Okay? All right. So there we go. Got that thing. So now you can check off deferred income tax. Well, that's cool. Okay? That's that 4,000 right there. Okay? What's left? Common stock. We did retain earnings, didn't we? What about common stock? What happened? What did it start at? 275,000. Oh, that went under operating, yeah.
Doing it operating?
Sure, because the tax expense is on the income statement, right? 27. But it really should only be 23. Cash went out.
Oh, you just
So it goes under operating. So I added it right there.
4,000.
Yep. Okay. Did it quick.
Is it income or invest?
Add increase in deferred income tax payable.
Okay.
Add increase in deferred income tax payable. If it decreased, I paid it with cash. If it increased, I borrowed cash. That's it. That's the way to think about it. So, good. All right. Let's try common stock. Starts at 275. What does it go to?
335.
335. And the other problem, common stock went down, which means they must have bought it back and retired it, huh? Like treasury stock. Kind of unusual. Here it goes up. That's more likely to happen in a company. What'd they do? I think they issued 60,000 cash. Don't you think it's debit, cash, and credit common stock? Of course, there'd be additional paid capital in real life, but we don't have it here, so we don't have to worry about it. Everybody good? What do I want to put down? 60. Where does it go? Common stock. Where does it go, everybody?
Financing.
It's in financing. Now, if I bought common stock, it would go in investing. And then if I sold that common stock, it'd go in investing, right? But what if I'm issuing my own stock or buying back my own stock, like treasury stock or something? Where does that go? That's equity. It goes in financing, right, guys? Keep that straight. It's kind of confusing, isn't it? Investment in somebody else is an asset. Their investment in me is equity, right? Which side of the deal you're on. But it's no different than bonds. Issuing bonds payable is debt. Investing in a bonds payable is an asset, right? Everybody good? Which side of the deal are you on? So how much accounting have you learned in here and how much business? I don't know, it's the same stuff. I don't mean all business is accounting. I mean there's no difference between business and accounting and marketing and management and finance. And it's just business.
We have to have,
Understand, right?
you have to have one to have the others.
Yeah, yeah. So it's all wrapped up. So, you know, if you understand business, you can do the accounting. I would say if you understand business, you can do the human resources. Yeah. If you don't understand human resources, you're not going to be any good as a finance or accounting person. You can't be a manager. Because guess who you manage? People. Human resources. Why do we call people human resources? We call it people, man. Okay, yeah. Human resources. Kind of you're turning people into fuel or something. But anyway, yeah. All right. That's what we do. Kind of funny. So where do you want to put that one? Of course.
Financing.
Yeah. Issue common stock, just like issuing the bonds. Don't you think? How much did we say it was? 60? Ta-da. We're brilliant people. So they got a lot of cash from issuing bonds and issuing common stock. Okay, what else is left? Oh, check that one off. Oh, no! Undo. There, came back. Okay. Let's do another one.
We have
I love that button. What do we have left?
loan to Horton Harker.
Yeah, and I said that's probably long-term. I'd assume it was because it's down there with the long-term stuff. You know, and I wish they'd separated it a little bit somehow. Okay, so loan to Harker, let's assume it's long-term.
So we gave the loan?
Yeah, it's a loan too. So what is that really?
We gave cash away.
It's it is a long-term note receivable. That's what it should be called, don't you think? That's what it is. But it's a long-term one, so what's that? Which kind of activity?
Non-current liability.
It's a non-current asset.
Non-current investing.
Investment. If it was a long-term note payable, it'd be a non-current liability, right? It'd be financing, right, guys? That's how you do this. So figure out where you're at before you analyze, huh? Make sense? Which, are we operations? Are we investing? Are we financing? This one's going to be investing, isn't it? What's the beginning balance?
Zero.
Zero? What's the ending balance? Looks to me like we debited that account for 40. What does it say down below? Anything about it at all? Nope. So what must be the deal? Credit cash, 40,000, and debit, 40,000 to loan to Harker, right? That's what they call the account. They call it anything they want, we don't care. Loan to Harker. Way to go, Keith. Debit on top of the credit. As most of my students, not most, lots. Okay. Got a loan to Harker and credit cash. Everybody got it? So what do we want to put on there? This one? Where do you want to put it? Kind of activity. Non-current asset. Where do you want it?
Oh, it's an investment.
Investing. Okay, so under investing activity, loan to Harker. We loaned, right? Or, you know, increase in loan to Harker or whatever. Cash loan to Harker. I don't care. Okay. How much? 40,000. More or less cash? Less. By the way, if you don't put brackets around that one, how much will you be off by?
40,000.
Not 40. 80, because yeah, it could go twice, wouldn't it? Because you'd add it instead of subtract it, so it'd be double. So when you get done, if it doesn't total up, always do that. Divide by 2 and see if there's something screwed up. Okay, which I'm pretty good at. The last class I did, screw up one of them. Students got me. All right, so then what else do we have?
We have a gain on sale of equipment at the top.
Yeah, okay, so we have gain and sale of equipment at the top, and also which accounts do we have left? Plant and equipment in one of them.
What's that depreciation?
Accumulated depreciation. That's it, isn't it? Check everything else off now. So we're doing the hard ones last, which is fine. You can do the hard ones last. I don't care. And then if you ran out of time on the quiz, oh, well, you got most of it. We have almost all the points now. We're only going to put a couple more lines down. Or you do this one first when you're fresh. Do I care? Not in the least. If you know what you're doing, you're going to have plenty of time on this quiz. Okay? Yes, there. You really know what you're doing. Okay, so which accounts are we working with? Obviously. Plant and equipment. Right? What else? That contra account accumulated depreciation is accumulated depreciation on plant and equipment, isn't it? And then there'll be depreciation expense. And look in the income statement, they've got a gain on selling equipment. That's really good you saw that because you already know it's there, don't you? So there's going to be a gain. Okay, now what happens? What do we start with in plant and equipment?
Started with
400,000.
What do we have at the end? 620? I bet we bought at least 120. Because all the purchases of equipment would go right in there, wouldn't they?
Yeah.
So what we're going to pretend everything was for cash. So what that's going to be is debit plant and equipment for some number. I don't know what it is yet. And credit cash, right? Yeah, it's one entry. What else probably could happen? You don't have to just buy equipment. What could you do? You could sell it, and that would come out of here, wouldn't it? So I would credit plant and equipment for whatever I sold, of course, right?
sold
And what would I sell it for?
cash.
Cash. And then what else would I get rid of if I sold it?
Depreciation.
Accumulated depreciation to go away. Everybody agree with that? That's one entry. Okay. Accumulated depreciation goes away. Whatever accumulated depreciation you have goes away. Am I right? Everybody's with me on this? Stuff you already know. You know how to sell a piece of equipment, don't you? Okay, let yourself use it. And then what else could there be?
Gain or loss.
It's a gain or a loss. It's a gain if I sell it for more than its book value, right? It's a loss if I sell it for less than their book value. In this case, we know we have a what?
Gain.
Gain. Okay? And then what else can happen to accumulated depreciation? What does accumulated depreciation start at?
130.
Yeah. We're doing the hard part last year, you guys, so hang in there. And then it's what at the end? 165. What would cause accumulated depreciation to go up?
Some of your equipment is
You're depreciating it, right? You credit accumulated depreciation and debit what when you depreciate it?
depreciation expense.
Yes. Okay. You guys know this, right? Those are the three things that could happen. Now you don't have to have sales of equipment, do you? But you don't even have to buy equipment. But I bet you always depreciate it, huh? If you have any. True. Okay. So let's figure out what those entries must be. We have bought at least 120, right? Everybody see that? 500 going up to 620. But we could have sold some, right? And we depreciated at least how much?
35.
35. But it might be more than that if we sold some, right? That's it. So what do you know here?
We know that the some of it was 10,000.
Oh, the accumulated depreciation on what we sold was 10?
Yes.
So what we sold, there was accumulated depreciation of 10, so don't you want to debit depreciation expense for 10 for that? Or accumulated depreciation rather for 10, right? And then what else would you want to get rid of? It costs 30, so wouldn't you want to credit plant and equipment for 30? So
We
that's
got cash for 26.
10 here and 30 here. What's the difference between those two? 20. We're explaining 20 of the change. And here's the hard thing. Both those accounts go together, don't they? We're explaining 20 change in those two accounts combined. Everybody see that? That makes it harder, hard to division. What do we sell it for? 20. This is 26?
Yeah, 26,000.
Yeah. Huh, I got debits at 36 and only a credit of 30. I need something else.
Gain or 6.
Of course. It's a 20,000 book value. You sold it for 26. You have a gain of 6. And of course, there's a gain on the income statement. Gain on sale. You see that? Now, that's still a real gain. I believe it's a gain. Of course, it's a gain. But what do you want to show on your cash flow statement?
You want to put it under operating activity.
You want to add, not add it back. You want to subtract that from operating because it's not operating. It's non-operating. It's down there under after operating income, isn't it? Gain on the sale. See that? It's non-operating stuff. They might even call that section non-operating on a real income statement. Got it? Okay? So that I want to take out of operations. And what do I want to show under, well, where do I want to show this? I sold equipment. Where do I want to show it? Investing. What do you want to show in investing?
Sale.
The 26,000 of cash, right? Because that's what you got. But what's the change in the account that we're explaining? Only 20, right? Well, guess what? 26 less 6 will be the 20. It works perfect. So let's go do it. Where are we going to put this? You wanted to put the 6 where?
Operating.
Okay, he's going to add back. Whoops, deduct. Come on, Keith. Deduct. It's not that a gain causes you to have less cash. It's that the gain is not an operating gain, right? So your 63 income's too high by that from an operations standpoint. Right? It looks backwards, doesn't it? Adding back the losses and subtracting the gains looks funny, doesn't it? Okay, but that's what we do. But it's only because we want to move it over into investing or financing wherever it belongs. Okay? So what I'm going to do is I'm going to deduct loss on, whoops, gain on sale. You want it to be a loss or something. A loss you would add, a gain you're going to deduct. It's too bad. The other problem I did, you guys need to watch that, had both a gain and a loss, so you can see both being done. Take a look at it, or at least work it and make sure you know how to do it, right? Okay, 6,000. So that I'm going to subtract out, because that 63 is too high by that 6. Make sense? From an operations standpoint. But then what do I want to do with the 26 cash that came in? Where do you want to put it, guys?
Investing.
Investing, and what do you want to call it?
Sale on equipment.
Sale of equipment. You got it. That's what we sold it for. It's the cash. Excellent. Now you can do what? What's that?
26 or 20?
It was 26.
Oh, yeah, because then you subtract 6.
Yeah.
Okay.
The cash was, yeah, and the 26 less than 6 is the 20.
Okay, I was thinking that you just put.
Yeah,
Okay.
yeah. So you don't just write the 20 change. The 20 change is there.
That'd be 14.
You put down both of those, and that net effect is the 20 change.
Okay.
The cash you got was 26. So write down the cash you got. Okay, so now what could we do? Let's look at plant and equipment now. It started at 500. We took 30 out. What did that make it? 500 less 30 made it what, guys? 470, and now it's 620. How much must we have bought? Obviously, the increase plus the 30 is 150. So I think I bought 150, don't you guys?
Mhm.
That would be debit plant and equipment 150 and credit cash 150. And I want to put the cash over on my cash flow statement. Where do you put this? It's a non-current asset. Where does it go? Investing. This gets easy, doesn't it? Okay? So what's this? Purchase plant equipment, right? Ah, how much did we pay? What is it, 150? Already forgot. That was it. Ta-da, right? I have less cash. We're doing what happened to cash, not what happened to plant and equipment, right? Okay, but that's explaining what's going on. Okay, good. What do we have left? Yeah, we gotta do the depreciation. By the way, now that I did this 150 and I did this 30, can I check off plant and equipment? Yes. I can't check off accumulated depreciation yet because I've only done one side of it, right? The 10. So if I started at 130, now it's 165, and I took 10 out, what do you think I put in? How much did I add? It must have been how much?
45.
45, which is what? Credit accumulated depreciation 45, debit depreciation expense 45. And down at the bottom, do they tell you depreciation was 45?
No, they just told you there was 10.
No. Oh, this is nice. This is harder than the other problem was they gave it to them, and the other problem didn't need to. They don't need to give us that. We know it's the depreciation expense, don't we? Do you see anything in that journal entry about cash? I don't. So on your income statement, you have expense of 45, reducing your income, that use no cash. The cash is used up when you buy the asset, or at least when you pay for it, right, guys? Which is not the same time as you depreciate it, of course. Okay? So what would you have? I'm going to have to add it back to operating income, aren't I? Add. Don't add accumulated depreciation, add depreciation expense. You're adjusting the income statement, right? I have students do accumulated depreciation. I'm like, what are you doing? Right? How much did we say it was? 45? Now you can check off accumulated depreciation, can't you? And we've done every single account. Discipline yourself. Every single account, once and only once. Check them all off. I'm done. Right? Now what? Add them up. Okay. What would this be?
39,000.
This is going to be called cash flow from operations. You like it?
We say
That
net
says
cash.
from.
We'll say net cash from operating.
That'd be fine. I don't care. So what the author does, cash flow, operating activities, you like that? Something like that. How much was it?
39,000.
Positive, negative?
Positive.
All right. What's this one gonna be called?
Cash flow from investing activities.
Yeah, sounds good to me. How much is that? Negative something, right?
164,000.
Fantastic. Okay. What's this one gonna be?
Cash flow from financing activities.
Can you guys envision yourself getting all the points on this? Oh, man. Yes, you can. 30 on the test, 20, or 30 on the quiz, 20, 25 on the test, another 20 on the final. How many points does that add up to? Out of the remaining 350 or 325, 75 of it? Wow. No, I had to do one problem. Crank on this what I got, okay? Just crank. And then work on other stuff too, after you have this mastered. But get it down. Okay, how much is this one? That's positive, right? 150 less 33, what's that? 117. And then what do we want to make sure of course? 39 less 164 plus 117, is that negative 8? Yeah. And does that agree with the key on the next page there? Are we brilliant people or what? This is an easy class. After you know how to do it. Remember I told you I have students in executive MBA that are open heart surgeons sometimes. It's like changing oil, like I said. I can't change the oil in my car, but like I said, you can valve for it anytime. No big deal. That's he knew how, right? He says, doesn't it make you nervous? You might kill somebody. It's easy now. He said, if you don't have that attitude, you shouldn't cut somebody off. Because some of them die. That's not a job for me. I can screw up your life, right? But you'll recover, won't you? Even if I'm managing your money and I lose all your money, you're still alive, right? You know. But if I rip your heart open and you die, you know, oh well, yeah, people die. Yeah. Gonna die sometime. Well, it's true. Okay, gang, study hard. I'll see you Monday. Remember, I'm not leaving yet. Right? Monday we have class on. I don't know, what are we doing? Preparing for the quiz?
Yeah.
So whatever you guys want to do. Whatever you want to do. We have a review session Monday too? Oh God, what are we going to do with all that time? You guys already know how to do all this stuff. People just cancel it. Yeah, maybe not. Sure.
So the bonds payable, you said like, we could sell all the bonds payable.
Yeah, if you did, you know, or we could retire them, right? If we paid them all off, we would debit bonds payable and credit cash for 100. I'd put that into my financing section as cash going out, right? To retire bonds. And then it would have been 190 issuing the new ones. This would have been debit cash, credit bonds payable for 190. I'd show that as cash coming in.
So you have.
So I'd show both.
You have to show both these.
Yes, yeah. On the non-current assets, non-current liabilities and equity, you show both the increases and decreases.
Okay.
Because they're major, they're big material items. On the current assets and current liabilities, we just show the difference.
Okay.
Because they're little tiny transactions, lots of them. Might be a big number, but it's lots of little transactions, so it's kind of meaningless to show both.
Okay.
Okay, good. Good question.